the first part of monetary policy, we learned about quantitative tools of monetary policy. Whereas in the second part of monetary policy, we will learn about qualitative tools of monetary policy. As well as in the end of video, I will give you a quick revision of all the 7 quantitative tools of monetary policy. Before moving to the concept, let's take an example. See, this is a commercial bank where public has deposited 100 crore rupees. And now if bank wants to give loan, then it is having 3 options. First is a businessman who need loan for business. Second is an employee who need loan for house. And third is a farmer who came for agriculture loan. Now the main problem with the bank is that what will happen if the person to whom loan has been given will not repay the loan back to the bank. So here bank needs some assurance that the person will definitely pay the amount back. And for such purpose, Reserve Bank of India came with a qualitative tool which is known as security requirement. So bank will take some security from the borrower such as cash, gold, car, house, land or any other thing. And if the borrower will not repay the amount, then bank will be able to realize its amount by selling all those securities. But still there is some problem. Businessman will give gold as security. Employee will give papers of his house. But do you think that farmer will also be able to give security equal to this businessman or employee? No. So in that case, RBI set one more norm, that is marginal requirement. According to that particular qualitative tool, bank will give loan up to some proportion of that security. Means if the person submit document of a car of 20 lakhs, then bank will give him loan of maximum 12 lakhs. If a person has deposited gold worth rupees 10 lakh, then bank will give him loan of 8 lakhs only. Here the proportion of margin will be different for different class of people as well as for different class of asset. And for different purposes, for example, if a farmer gives document of land for 10 lakh, then it may be possible that he will get loan up to 10 lakhs rupees also. So that the poor farmer can also get all the credit facilities which has been provided by the bank. Still, sir, there is a problem. What if bank will give loan directly to the businessman? What if bank will reject all the loans of farmer as it is aware that farmer is not able to give much securities? And bank will give 100 crore rupees as loan to businessman? Then again RBI is having a tool for that. It is selling on credit, which means that RBI has decided some percentage of loan for every purpose. Here if bank is having 100 crore as deposit which bank can give as loan, then it can give loan of 60 crore to businessman, 30 crore for home loan. But at the same time, compulsory bank has to give 10 crore rupees as loan to farmer, so that he must not get deprived of the banking facility. Still there is a problem. Sir, still there is a problem. Sir, can farmer pay the interest equal to the businessman? I repeat, can farmer pay the interest equal to the businessman? Definitely not. Definitely farmer cannot pay such a high amount of interest just like a businessman. So here RBI set discriminatory interest rate, which means different interest rate for every purpose of loan. So bank has to take high interest from businessman or on home loan, and it has to charge lower interest from the farmer. For example, bank can take 12% from businessman, 10% on home loan, but bank has to charge only 4% from that particular poor farmer. So this is the way that RBI uses its qualitative tools for equal development of economy. Here all these tools are used to develop some selected sectors only. So it is known as selective tools also. Let's see in detail all the qualitative tools. First is security requirement. To get assurance about repayment of loan, commercial bank will take some security against lending the amount, such as car, gold, house, land, etc. Take different amount of securities from all the sectors, such as higher amount of security is taken from rich businessmen and lower amount of security is taken from poor farmer. And if anyone is not making repayment of the loan, then bank will realize its money by selling all this security. Such policy is made by RBI so that all the section of society can avail the facility of bank credit. Second qualitative tool of monetary policy is margin requirement. According to this tool, an individual will get loan up to certain percentage of the security deposit. Here, Reserve Bank of India sets margin for loan against security. Banks are directed to keep different margins for different purposes. Here, margins are kept very low for the businessmen, whereas margins are set extremely high for poor farmers. Means if a business which is giving security of 50 crore rupees, then it will get loan of hardly 40 crore rupees. Whereas a farmer who is depositing papers of the land of 10 lakh rupees, then he may be able to get loan up to 10 lakhs rupees also. So this is how the margin requirement fulfills the requirement of all classes of economy. Third main point is ceiling on credit. Friends, ceiling means limit. So by this tool, RBI decide limits for credit for different purposes. Here RBI will decide that out of the total deposits, bank can give 60% loan to business, 30% loan for different personal purpose such as car loan, home loan, and compulsory bank has to give 10% for agriculture loan. This is just an example. On the basis of market situation, Reserve Bank of India is specifying limit for the credits. And the fourth and last point is discriminatory interest rate. As we have seen that a farmer will not be able to pay the same interest as businessman is able to pay. So as per the guidelines of Reserve Bank of India, there should be different rate of interest for different purposes. And bank has to charge differential rate of interest, which is called discriminatory rate. For example, high rate of interest is charged from businessmen, whereas low interest is charged from farmers. So in this manner, Reserve Bank of India took some special steps so that bank credit will be available to poor person in easy and effective manner. Friends, in the last part of our video, I have tried to cover all the quantitative tools just in one screen so that you will be able to revise it in an easier manner, as well as if you have any confusion regarding all these 7 tools, then it will get removed over here. If you have seen my first video of monetary policy part 1, then you will be able to revise it along with me. Let's start. First, CRR. CRR stands for cash reserve ratio. What is CRR? Then bank will have to deposit some proportion of its total deposit with Reserve Bank of India. How much percentage? Initially RBI was charging 2% on time deposit and 5% on demand deposit. But since 1962, it varies between 3 to 15%. Based on the market situation, Reserve Bank of India is increasing or decreasing cash reserve ratio. Second is SLR, statutory liquidity ratio. Here bank do not need to submit anything with the Reserve Bank of India. Bank just need to maintain 25% of its total deposit in cash, gold or securities. Which kind of securities? It was unencumbered securities, means the securities which has been purchased by the bank by giving cash. It is not purchased on credit. Here Reserve Bank of India is using both CRR and SLR as tool to manage supply of money in the economy. Whenever there is situation of inflation, then Reserve Bank of India will increase both CRR and SLR. And whenever there is situation of recession, it will reduce CRR as well as SLR. Third, bank rate. The rate at which Reserve Bank of India gives money to commercial bank for longer period of time. Longer period of time is the keyword which you need to keep in mind. For longer period of time is known as bank rate. It is generally 7%. Whenever there is low bank rate, then it is considered as cheap money policy. And whenever bank rate is high, then it is considered as dear money policy. Generally at the time of inflation, dear money policy is followed, means Reserve Bank of India will keep bank rate high to reduce supply of money in economy. And whenever there is recession in the market, cheap money policy is followed, means Reserve Bank of India will keep the bank rate low. The next quantitative tool is repo rate and reverse repo rate. What is repo rate? That when commercial banks are in need of finance, they will sell some of their securities to Reserve Bank of India and they will get money from RBI under the agreement that commercial bank will repurchase all those securities after the specified time. Okay, the repo rate was set at 6.5%. When the situation got reversed, now RBI need finance and RBI gets money by selling some of its securities to commercial bank, then it is considered as reverse repo rate. Then it is considered as reverse repo rate. Reverse repo rate was set at 6%. The next quantitative tool is stabilization policy. Reserve Bank of India allows special window for emergency situation. Whenever any commercial bank need very small amount of finance and in emergency situation, then without any detailed procedure, without any kind of transaction related to securities, RBI will lend the small amount at 7% rate. Second last quantitative tool of monetary policy is sterilization policy. Sterilization means to maintain the balance of foreign exchange in any economy. So, as and when there is excessive inflow of foreign exchange, then RBI will sell some of the government securities and let the foreign exchange back into Reserve Bank of India. Sometimes when there is excessive outflow of foreign exchange, then Reserve Bank of India will buy government securities from the market and increase the flow of foreign exchange in the market. So, securities will come back in the hand of Reserve Bank of India and foreign exchange will come into the market. So this is how the sterilization policy is aimed to maintain the balance of foreign exchange in market. The last one is open market operation. I have earlier said that there is a very thin line between sterilization policy and open market operation. Whenever there is situation of inflation, then RBI will purchase government securities from market, and whenever there is recession, then RBI will sell government securities into the market so that supply of money in the economy will get maintained. Friends, here I should recommend that you should either take screenshot of this part of video or you should follow me on my Instagram page, that is elearner_slide. One more thing is that if you like the video, then do not forget to press the like button and share the video to your friends so that they will also be able to learn in an easy and effective manner. Thank you.